It seems now is a great time to go over why the mother of all short squeezes, commonly referred to as the MOASS, will never happen. And in fact, the market is designed to prevent such occurrences from happening, period. And this seems like a very relevant time to go over this information, as many people were expecting such a squeeze in the stock MMTLP, which was halted Friday, and other people also expect such MOASs to occur in stocks like AMC and GME. So after watching this video, you're going to understand exactly why a MOASS didn't happen in MMTLP and why you should never expect them to happen at all, period. And to clarify, I'm not saying short squeezes can't happen, but expecting to set your floor price at $20,000, $500,000, $1 million a share and so on is never happen. It's impossible. So you're going to want to watch this video entirely through, as I'm going to debunk the common misconceptions everyone seems to have about short selling and how short covering works, such as the actual fact that shorts never actually have to cover. You're going to get more DD in this video compared to basically all the other DD you've read in the last 2 years from the short squeeze communities in the next 5 minutes of my video. So remember to like, share, and subscribe to get more great content, and let's dive right into this. So to start, we need to start at the basics of how short selling works. So when in a short sale, you have three main parties. You got customer A, the person who has the shares, customer B who wants to short sell the shares, and the broker in between them. So basically what happens is customer A lends his 100 shares of ABC Corp here to their broker, and then customer B borrows 100 shares of ABC Corp from their broker as well. And now, customer A has an IOU for 100 shares of ABC Corp from their broker, and customer B has now sold their 100 shares to customer C in this case, who has bought those 100 shares. And hypothetically, customer C could now loan out those shares again and get an IOU just like customer A, and this can continue as many times over to create a bunch of actually IOUs of shares in the market. And an important thing to understand is the broker is going to set the margin collateral the short seller, in this case customer B, needs to provide. And this can be over 100% to protect them. In fact, when AMC and GME did short squeeze, the margin requirements did go up to 200% for AMC from Schwab, for example. Now, let's break down some basic facts about customer A. Customer A no longer has 100 shares. These are not synthetic shares. All they are is an IOU for those shares from your broker. And you don't have voting rights anymore. In the eyes of the company of those shares, you are not a shareholder anymore because you've loaned them out. And what everybody completely fails to realize is the broker does not have to return those shares to you, which we're going to go over later. So now we arrive at this scenario where customer A wants their shares delivered back, but because customer C doesn't want to sell to customer B cannot buy the shares back. And what actually happens for customer A in this situation, if the shares can't be delivered back, you're just going to receive the collateral and cash or treasuries of the same value of the stock. And this is actually in every broker's terms of service. And this is why customer B originally had to put up collateral to borrow those shares to begin with, because that collateral is to make you whole if your shares cannot be delivered back. And we can see this is how lending to short sellers works from the different brokers basically lending programs. You can see on Interactive Brokers here, they have their stock yield enhancement program where you can agree to loan your shares out to short sellers and you're going to receive some interest in return. But even if you just go down their main page, you'll quickly come to the considerations and risks where you actually clearly see you don't even have the voting rights of the company as we went over before. And also it states that you aren't protected by the SIPC anymore, and this is why under the SEC rules, Interactive Brokers must provide you with U.S. Treasuries or cash collateral of the same amount of the value of your shares to protect you in the unlikely event that this stock is not returned to you. So at this point now, we've completely debunked the thing that the short sellers have to cover because your shares have to be returned to you, because if you've loaned out shares, you do not have any actual right to get those returned to you. You can just have cash or treasuries returned to you instead. So for a fact, the shorts do not have to cover. So now back to our short selling example. Customer A didn't receive their shares back, so they received cash instead of their shares. This is because customer B could not buy back their shares, and likely their broker is going to have margin called them and taken all the cash in their account as collateral. And in this case, customer B never had to buy back the shares. They never had to cover. it's going to be the broker's responsibility to make you whole in one way or the other. And if they can, with the collateral they've put up from customer B, or what they think they can get from customer B, they can buy those shares back, they will. But if they can't reasonably do that, you're just going to receive cash instead of those shares. And this is because customer A and B have agreements with the broker, not each other. And customer B never needs to cover. You can just liquidate their account. And this all comes down to the broker's responsibility of managing the risk in both these agreements. And this is why we went over previously, the broker might require more than 100% collateral to short sell shares that are moving quite volatilely. At this point, you're probably saying, well, the shares are there. I just want whatever my floor price is, $10,000, $50,000, $100,000, whatever imaginary number you have in your mind. But the expectation of this goes directly against the SEC's mandate to maintain orderly markets. As you can see on the SEC website in what we do, their job is to maintain fair, orderly, and efficient markets. And well, what is an orderly market? An orderly market is a market in which supply and demand are reasonably equal. And this goes directly against the idea of the mother of all short squeezes, or a MOASS, because for that to occur, there has to be a severe imbalance in supply and demand of the shares. So what happens when there's a severe imbalance in supply and demand for the shares? Well, on the FINRA website here and also the SEC website, it's very clearly laid out that if there's a significant order imbalance between buyers and sellers, they're just going to halt the stock. And as we know, after the stock has been halted, the broker actually can't trade it anymore. And if they can't fulfill their obligation of getting your shares back, as we previously went over, they can just pay you in cash. And this gets into exactly why the MOASS, the mother of all short squeezes, can actually never happen. And we're getting to see this play out in real time with MMTLP. Well, MMTLP is an OTC stock, so it's covered under FINRA. You can see the rules that it says it determines that an extraordinary event has occurred or is ongoing that has a material effect on the markets for the OTC stock, or may cause major disruptions to the marketplace, or significant uncertainty in the settlement and clearance process. So they're actually plainly laying out, if brokers would ever have a problem settling and clearing the stock to settle up short positions, for example, they can just halt the stock. And then, as we know already, if you've lent out shares, the short seller, your broker doesn't actually have to return the shares. Again, they can just give you cash instead. And this is why there was no MOASS for MMTLP. And really the same applies for stocks under the SEC as well. The same type of resolution is going to happen. And I already know what a lot of people are saying, but what about the naked short selling? Well, first of all, naked short selling is illegal, and those doing it, if they were caught, they're likely going to be fined, and if they're doing it at a large scale, they're going to be shut down. And I highly doubt any large brokers would be doing this. It may happen in smaller shady brokers, but the large brokers, it's just too much risk. And even if a large broker borrowed shares from the smaller broker, the liability would end up falling on the small shady broker. And also the idea of naked short selling, there's really no proof this is happening. As we already went over how the lending process works, you can have the same shares lent out again and again and again and again and again if the parties agree to. And every time it's lent out, that previous party is just left with an IOU, and they don't actually need to be compensated with those shares back. You could just receive the cash value. And the fact is, the SEC is not going to let the mother of all short squeezes happen, in the event, especially in the event of naked short selling. They're just going to halt the stock as per their mandate to keep an orderly market. Because if there was massive naked short selling, this would create a huge imbalance in supply and demand, so they would have to halt the stock. So what would happen? Well, if you don't get your shares back, just like loaning them, in this case, you should get them back, but if you got naked counterfeit shares, you're just really only going to be entitled to maybe their fair value, their last traded price, or whatever remaining assets the broker that did the naked illegal short selling has if they default. You're not going to get your set floor price. It's pretty irrelevant. And if you just think of this from any other context, if you had, for example, ordered something online, a one-of-a-kind painting, and then the seller failed to deliver it, well, you can't say, well, in my mind, that painting was worth 1,000,000 times the value, and that's what I want for it. Well, you go, to court and this and that. The judge is just going to say, well, this is the fair value of it. This is what you're going to get. So at the end of the day, if there ever was an event where a MOASS started happening, the SEC is just going to halt it, and you're just going to get a payout in cash instead of getting the shares, whether you lent them out or you bought shares that were naked short sold. So I hope you enjoyed this video, or at least found it informative. My goal was to really just clear up the facts about short selling and if a MOASS was actually possible. I know a lot of other people have been putting out there in those communities all this needlessly complex due diligence, diving into these little things here and there, but as you can see from what I've presented, they're missing very core key facts that basically prove the MOASS will never happen. The SEC will just halt the stock, and at the end of the day, you can just be compensated with cash at a fair value rather than receiving the stock. So I hope you like, share, and subscribe to my channel. I intend to put out more great content. Leave a comment below. Tell me your thoughts on this. I know a lot of people are going to think, well, this is unfair, but if your expectations of a MOASS is what's fair, that's fairly unreasonable because the market is not designed to let MOASSes happen as per the SEC's mandate to keep an orderly market. So remember, like, share, and subscribe, and come back for more.